Welcome to our financial management course. In today's short lesson, we are going to talk about an idea that is extremely important in investing and portfolio management. That idea is correlation. Now, this will not be a statistics lecture. Instead, I want you to think about correlation in a more practical way, the way investors experience it in the real world. By the end of this lesson, you will understand what correlation means, why it matters for investment portfolios, and how investors use it to manage risk. Let's start with a simple story. Imagine one of your friends has just started investing. You meet them at a coffee shop and they tell you, very proudly, "I finally built my investment portfolio." You ask them what they bought. They say, "I bought 5 different companies: Apple, Microsoft, Nvidia, Amazon, and Google." They smile and say, "See, I diversified." At first, that sounds reasonable. After all, they bought 5 different stocks. But if you think about it carefully, something important might be missing. Are these investments really diversified? Or are they all likely to move in the same direction? Let's imagine that the technology sector has a great day. Investors are excited about new innovations and strong earnings. Apple goes up, Microsoft goes up, Nvidia goes up, Amazon goes up, Google goes up. Everything rises together. But now imagine the opposite situation. A negative technology report comes out. Investors become worried. Suddenly, those same stocks start falling, and they fall together. This is the key idea. When investments tend to move in the same direction at the same time, we say they are positively correlated. Think of this like preparing for a rainy day. Suppose you pack 5 items for a trip, but all 5 items are umbrellas. Technically, you brought 5 things, but they all solve the same problem. If the weather changes and the problem becomes intense sunlight instead of rain, your 5 umbrellas do not help much. In investing, buying many assets that behave the same way creates the same problem. You may own many investments, but if they move together, your portfolio may still be very risky. Now imagine a different portfolio. Instead of buying only technology stocks, an investor spreads their money across different parts of the economy. Some technology companies, some healthcare companies, some consumer goods companies, maybe some bonds. Now something interesting happens. Technology stocks may fall on a particular day, but healthcare companies may stay stable. Consumer goods might even rise. These investments do not always move in the same direction. Their correlation is lower. This is where portfolio management becomes powerful. Investors are not only choosing investments with good returns. They are also choosing investments that behave differently from one another. Why? Because when assets move differently, losses in one investment may be offset by stability or gains in another. The portfolio becomes smoother, less extreme, less volatile. In other words, diversification works best when assets are not highly correlated. Professional portfolio managers think about correlation constantly. They ask questions like, if the stock market falls, how will bonds behave? If energy prices rise, what will happen to airline stocks? If technology declines, will other sectors remain stable? By combining investments with different behaviors, they create portfolios that are more resilient. The goal is not to eliminate risk completely. The goal is to avoid putting all your eggs in baskets that move exactly the same way. So the key takeaway is simple. Diversification is not just about owning many assets. It is about owning assets that behave differently. Correlation helps investors understand how investments move relative to each other, and it plays a central role in building strong portfolios. Thank you for watching, and I will see you in the next lesson.